So, you ready? 3, 2, 1, talk.
Okay, yeah, I'm Alex. I'm the managing director of WestTech Ventures. We just 2 slides or so about what I do so that you understand where I come from. We are a Berlin-based seed venture capital firm. We have 30 investments right now, most of them in the seed phase. And seed phase for me is a phase where maybe your company exists for a year or so. You try to get money from investors from whatever, 300,000 to 1 million or something like that. That's a typical seed round for me. That's difficult to invest there because we cannot rely on so many KPIs because the companies are pretty young. There may be some first customers, but not necessarily or users, not necessarily customers or paying users. And so it's an interesting, exciting business to be in. But we discovered that also, besides the seed investing, we wanted to help companies and founders who are even younger with their project. And that's why we created Project Flying Elephant, which is our incubator. And the mission was to make something heavy fly. And the heavy thing is to make your startup, your first startup, to make it grow and survive the first couple of years. And we did this with a couple of companies so far. 2014, these are some from 15. And this year in October, so in May, the applications will start. In October, we will have hopefully new 6 or 8 companies with us again and helping them. We do this mostly in topics like deep tech, media, B2B, software, so in the digital world. And I wanted to tell you about how I'm on the receiving end of a lot of business plans. So a lot of founders talk to me and want to get investment money to build their product, and I want to help you from my experience in the last couple of years how to do this. And one big advice would be a very simple one. I've drawn a very exciting and complicated diagram about this. This is like, I stole it from Mark Suster, a very famous and experienced investor. And when I meet people, so I have hopefully a very good impression of the project, of the team. But what I really would like to see are a couple of things, to meet them again, maybe just for a minute or two, to inform me what are you planning, what are you doing, and maybe like 4 weeks later or 8 weeks later, I learn a lot more because you tell me, okay, we have done our prototype is ready, we have found our first intern and all this. So ideally, if you want to raise money, it doesn't matter whether it's an angel or VC, try to build a relationship is my advice. And how can you do this? Try to be at events like this one, try to be at many other events, use your network from other founders, ask for investors they trust, they believe in, and get introductions. That's the best way. Because when we are looking at our portfolio, I probably would say that, I don't know, 80, 90% of the investments we made came through introductions. And that's not because I don't look at emails I get sent just at my email address. It just happens. It just happens. It's not ill will. We check every application we get, but try to get an intro. And my advice would be, this is a typical view I hear from a lot of startups we invested in or did not invest in, that this could be a very good way of doing it. Try to do a short list of like 100 you like, and do an even shorter list of the ones you want to contact. And so go the whole way down. You basically, I would advise to do the same like investors do with startups, because this would be the way an investor looks at startups. So this is not so far from the truth. So that a company gets like 1,000 business plans a year. And this number is really there are VCs, bigger VCs who have 2 times or 3 times this amount of incoming deal flow. So that means they cannot meet everybody. So that means if you have managed to get a meeting with somebody, and my advice would be to talk to anybody in the investment firm you can meet, because it really doesn't matter whether it's an even an intern or an associate analyst, it doesn't matter. You need some sponsor of your idea. So if you find somebody who likes what you do, great, no matter who it is. And you see the whole process goes down to whatever 10 investments in this year. And that means there's a 1% or 1 out of 100 makes it. That's basically the number, and that's a pretty normal number for many other VCs I know. So the 1% is not so bad. So, and that means you have to do a lot of sales to reach where you want to be. Last year we did, if I count the angel investment and seed investments together, I think we did 14 investments, so quite a lot. And that means we did quite a lot of discussions before. I would advise, if you plan to get angel money or money from a VC, my advice would be to plan something between 2 and 6 months for doing this, because it really takes a lot of time. Basically, you are a very young company, a team of 2 people or 3 or so who want to sell a part of the company for a very high price if possible. You know, the higher the better for you. So, and it's a sale you do for 50 or 100,000 or a couple of 100,000 euros. So it takes time to do this. If one of you is he or she is a good salesperson, I would try to delegate this to her or him, and I would like to let this person to do the talking and get this first sale done, the first sale before you sell to your actual customers. Ideally, you have found somebody who likes your project, an angel or a VC, and that means you are in the phase where you should try to sign a term sheet. The term sheet is nothing else but a short summary of the most important terms you want to have in your contract later. So it's like an LOI, it's like a first contract you sign with 5 or 10 pages maximum, where you say this is going to be in the long contract, which has to be done so that everybody knows what he or she is talking about. And my advice is to be every founder, not only the person who does the talking to a VC, should understand most of these terms, or at least these 5 or 6 I have here. You don't need to be a lawyer. You don't need to study law in order to do this. There are enough blogs about this. But try to understand what this means. And even if you don't want to get an investor on board and you just plan to do some nice, profitable business with a friend of yours, do at least the point vesting. That's an important point, because it's a point which clarifies what happens if you split up and only one of you or 2 of you go on with the company. It's the thing you should have in place if you found the company in the first place, even if you don't never want to have investors on board. My personal 4 favorite ones, not surprisingly 3 from the US, are these 4 blogs where you can read about all these terms and other advice for startups, but particularly with a focus on fundraising and yeah. So I like them a lot. As I said, I would try to see this getting an angel on board, or whatever, 25,000, 50,000 from somebody. It's your first sale, and you should be really all engaged, in my opinion, because you should really try to look at who is here. Berlin is easy because there are so many angels, so many VCs. But what I would try to if you're on your shoes, is get feedback from other founders. Get feedback from founders who are on the list that the investor has invested in them, because then you really know whether what he or she is telling you, whether this is marketing or whether it's true. So get real feedback. Do your own due diligence on investors. That would be my advice. And another advice I would do: due diligence, not only whether you want to work with them, whether they are trustworthy, or whether they are fair, or whether they can help you, but also you stay together with them for many years, for 5 years, for 10 years. So, and they can really, even if you like them in the beginning, they can really screw up the development of your company if you don't get along with them. So do something. Well, some people say do the beer test. So if you want to have a beer with them in an hour and that's a good time, then do this, and then that's that helps a lot with the gut feeling, I believe. And it's an important time. It was sometimes underestimated because as a founder, one has worked hard to get where you are and you want to get this money, but I would advise to do this due diligence and rather pass on something when something seems to be fishy. My advice would be, people ask me sometimes, how should I do this? How much of my company should I give away for a certain amount of money? And the easy answer is as little as possible, because you want to have the majority of your company. On the other hand, what I would say is it's normal to give away something between 5 to 25%. So probably the majority of the deals are often between 10 and 20%. And that also, if you need a certain amount of money for, let's say, a year, my advice would be to be able to live and work for a year with the money you raise. No matter whether you raise 50,000 as an angel round or 500,000 later, it should be, the number should be, you should be able to live for a year or ideally longer. And I would try to get, if you have people you trust a lot, people whose advice you trust, and you want to get them on board, ideally, and you want to give them, let's say, a so-called advisor share, so 1, 2, 3% or whatever, in order for them to be a mentor to you, I would advise to combine this with a little money they put into your company. Even it depends on their personal circumstances, how well off they are, but ideally you get some money from them so that they are really interested in the well-being of yourself and your company. So a couple of €1,000 or so in the beginning is fine, so that you just have some skin in the game. And since I can see the time as well as you, so I'm at the end of my short intro. The 10 things you need to know about getting venture capital on board. So.